all the topics, but obviously the structure that I put in this presentation makes more sense.
Okay.
Because I feel that if we divide the topics like 1, 2, maybe we don't have the same perspective. So I put the topics in a logic sense in order to understand better what is the next topic. So, but at the end, we are going to review each of the seven
Okay.
topics.
Okay. Okay. That's fine.
So, first of all, and the topics is the story and the current environment of audit, how we can apply the rules and what are the professional code of ethics for auditors, what are the professional requirements when we are performing an audit, what is an audit monitoring process. We are talking about risk. We are going to talk about the relation between accounts preparation and the conduct of audit, and finally the main developments in audit. So the concept of audit basically is an examination or inspection of different books of accounts or internal controls. This is very important because some people believe that the audit normally is based on reviewing accounts like for example cash and cash equivalents or fixed asset, but no, audit is also checking the internal control of the firm, of the company. I mean, what are that kind of filters that the entity has in order to information and in order to protect the most important thing, that in the case of the firms are the assets, no? And probably the money, probably a fixed asset. So auditing is the inspection of the internal control, but also the financial statements. Audit is also an independent examination that the who is controls or that for those financial statements needs to be a person that doesn't belong to the company, because probably if the person that belongs to the company could be like we can find the person needs to be outside the company, needs to be a third person or an independent examiner in order to express an opinion. If the internal control, or in that case the financial statements reflect the correct or the reality, or in general terms. Audit is a systemic process. What systemic process means is that we need to follow a step by step, an order. We need to plan the audit, then we need to do the audit, then we have a stage and we are going to close the audit, in which we are going to get the results and the findings, and at the end we are going to give an opinion. And all that process is based on of the audit, and the most important that
you are breaking
is sorry, can you hear me?
Yeah, I'm hearing you. Sometimes you just break off and come back. Yeah,
that last part. Audit systemic process, it means that we need to follow way, a specific way with order. We need to have I feel that okay.
Your network is breaking and coming time that.
Yes. Okay. So again, it's a systematic process in and we are going to follow that criteria is established regulation or rules that are very important for auditors. In rule of auditors is internal, the ISAs. I don't know if you have knowledge about that. We are going to explain the international standard of auditing. So here we discover that we have audit. That audit implies internal control on one side, and in another side financial statements. So in the side of financial statement, we are going to examine the accounts and we are going to express an opinion about if the financial statements are prepared in all material aspects. Material aspects means in general, according to a specific set or rule of rules. So if the company has opinion about its financial statement would have a high level of confidence. So for that reason, most of the companies look for an opinion from an examiner, an auditor, because if they have an opinion, obviously they could get money from the bank, or probably they can they in a stock exchange, or maybe and would be more attractive for investors, because another part is telling us that this company is reflecting the financial reality.
Yeah, yeah.
So these are the benefits of the audit. So the audit helps to examine, control, and monitor the economic situation of the company. And because of that, we can detect processes that are not working correctly. And additionally, another benefit of the audit is that the firm or the company is going to be sure that it is following the rules, the international rules probably, or regulatory frameworks, depending on the probably the country in which the company is operating. And another important thing that the audit is going to help us is to take a better decision, because other party or other person is going to guarantee that the financial statement reflects all the figures correctly. So obviously the stakeholders of or the investor are going to take better decision, because they are looking the truth of the company.
Yeah. Better decision.
So we have two different audits. One is external audit, another is internal audit. So in this slide we can see the difference. For example, the objective.
Yeah.
The objective in case of the external audit is express an opinion of the financial statement. But what happened with the internal audit? The internal audit is going to be based in internal controls, improved internal control of the company. The moment, this is another difference. For example, in external audit, the external auditor is going to review the past, because obviously the company needs to close the operation of 1 year, and then the external auditor is going to review that year. For that reason, in external audit, we take the past of operation, the past events. And in the case of internal audit, is in the present, how the internal control is working now. And if we can fix the internal control, if we find some things that are not working properly, we need to change, and this is going to get a result in the future. For that reason, the moment is different between external and internal.
Audit, yeah.
Another difference is the audience. For example, the external audit is for the opinion that the external auditor is going to give is very helpful for investors, general public, and regulators. And in the case of the internal audit, is more for the owners of the company, the executive manager, management, or in some cases regulators, because for example, in the banking field, some regulators ask for an internal audit. So probably the audience in internal could be also regulators. Framework use or set of rules. For example, in external, the auditor is going to follow the internal auditing standards. And in the case of internal, is according to the company. The company can use many frameworks, but the most common is the International Professional Practice Framework, or internal policies and procedures. So it's more based on the decision of the company. And the last difference is that the external auditor is contracted by the company, of if we have a group of companies, normally the same external auditor for the holding or for the main company is the same auditor for the rest of the companies. And in the case of the internal audit, the internal auditor normally, but not in all the cases, is part of the organization, is one employee of the organization that is the internal auditor. Not in all the cases, because for example, I have seen some companies that they have they outsourced the internal audit, but it's the most common that the internal auditor is part of the company in the case of internal audit. So basically, in this slide, you can see the difference between international audit standards and international professional practice framework. Both are a set of standards. Obviously, the body that emits the international audit standards and the international professional practice framework is different. Are important because both is like both of the framework are like a kind of guidance for the auditors and how they can do an audit, external or internal audit. And the structure is also different because are two different frameworks. In the case of the international audit standards, we have 36 standards divided in 8 series. And for example, in the case of internal auditors, we have 2 sections. And mandatory, the international audit standards are mandatory. It means that in all the external auditing, we need the international auditing standards. This is mandatory. And in the case of internal, we can decide if we use this framework or if we use another framework different. So, but basically in external audit is always the same framework.
Okay.
So here, this part, I put here the international standard audit. So in this, if you read this standard, you are going to find the overall objective of the independent auditor. And for this, the auditor needs to fill ethical requirements, professional judgment, and professional skepticism. So it means that those are the characteristics that an external auditor needs to have. So ethical, we are going to talk a little bit more in detail in some of the slides.
Okay.
But basically, ethical requirements are that things that like kind of values that the auditor has. Professional judgment is that the auditor must have experience and knowledge, and in order if the auditor has that professional knowledge, obviously can just better the performance of the company. And the last one, professional skepticism, is like the auditor cannot trust everything. So the auditor needs to ask himself and questioning the company why. So because it's like kind of because he's investigating many things about the company and he's looking for the truth. So it's like, don't believe in all the things that the company used to tell, but at the same time is like, I'm not going to trust, but and I'm going to have evidence about all the decisions or all the adjustments and all the conclusion of if a firm tell me that this I don't know, that document shows something, I need to see the document.
Sure.
So this is the code of ethics. We don't have a code of ethics specific for the auditor. We have a code of ethics in general for the accountants. So we have 4 pillars. The first of it is integrity, is be honest. The second is objectivity. We need to avoid conflict of interest. Imagine that you are auditing the company of your brother. It could create a conflict of interest because probably if you are the external auditor and because of your relation with your brother, you can say, okay, I'm going to show a very good financial statement, and probably, or I'm going to show the truth, but it could be a conflict of interest because probably another investor could think, but they are brothers, so probably that guy is not telling me the truth. So we need to avoid a conflict of interest or influence. Then confidentiality. So because the external auditor is managing a lot of sensible information, we need to, the external auditor needs to be sure that all that information keeping secret or keep total confidentiality. And the fourth one is a professional behavior. Why? Because if an accountant or an auditor is following the rules, he or she, the external auditor or the accountant, is giving a very good image of the accountants, or in general, the profession. So it's very important professional behavior, because we need to boost the profession instead of give a bad image of
Bad
of
image,
the
yeah.
of the profession of the accountant or the auditor. So when we start an external audit, we need to keep in mind that we need to sign off a kind of contract with the company that we are going to audit. And in this letter, or in this contract called the Agreement of Management,
Is it different from engagement letter?
mm, I don't know what do you mean about general letter?
Engagement letter.
No, it's the same.
Is the
Like,
same. Okay.
is like the letter in which the company recognized that the company has a responsibility
Okay. Yeah.
to let the auditor check all the information.
So,
And another thing that we can find in this agreement is the objective of the audit. The scope, for example, the scope could be like all financial statements, or maybe taxes, or maybe internal control, or maybe another process, or another services that the firm can gives. So we are going to find the scope, responsibilities of the auditors, and the reports, the fees, the time, because normally in external audits we have the two stages. The external auditor used to go twice per year. So, but in this letter, in this contract, we are going to find all of these details: the team, how many people, who will be the manager, who will be the staff, and who will be the partner that is going to sign off the opinion. So this is the agreement of management. So we need to have this agreement before start the audit. So then after that agreement, we need to, we are going to call, before this agreement, we need to develop the audit. But
yes.
what would be the result of that work? The result of that work will be an opinion. And in that opinion is our conclusion. If the financial statements are free from material misstatement, it means that if we don't have, if the company doesn't have any problem that could affect the decision that probably the shareholders or another person, another people could do with the financial statements. That is the result of the work of the external auditor. We have 4 different opinion. A qualified opinion is an opinion and we don't have any problem. Basically, we have a qualified opinion with emphasis, with a paragraph, emphasis paragraph is when the auditor is saying everything is fine, but there is a issue in this part. And obviously in that opinion, the issue is described. It's not bad, but I could say that it's not totally good. It's like kind of yellow. Everything is good, but there is something that we need to pay attention, or the investors or the shareholders or the regulators need to pay attention on that issue. Then we have adverse opinion. We don't have, we have we have checked all the information but we are not satisfied, and we didn't get sufficient audit evidence. So the external auditor cannot guarantees that the information is correct.
Yeah.
So, but worse than that is the disclaimer opinion, is when, in this case, in the case of adverse opinion, we check the information and we say that, and the auditor says that the information is not correct. And in this case, in the disclaimer opinion, we are telling that the opinion, the auditor didn't have access to the information of the company, even though we have that letter or that contract. So this is very, very bad scenario, because in this case, the company is not following the agreement that the company signed off. So this is the worst scenario, in which the auditor didn't have access to the information of the company.
But and I think the adverse opinion is equally the same as the disclaimer opinion. Are they not all worse?
No, because in the adverse opinion, both are bad. But in adverse opinion, we are saying that we check, but we find a lot of we found a lot of errors.
Okay. But you have checked and confirmed.
Exactly. And the disclaimer opinion, we are saying that we cannot get an opinion because in fact we didn't have access to the information.
Yeah.
Mm-hmm. So so here we have talked about the things that we need to have before starting an audit, and the result of the external auditor work. In this part, because it's a little bit bigger, we are going to talk about the planning and the execution of the audit. So for that, we need to talk about audit strategy. In the audit strategy, or in any other strategy, we need to know the direction, timing, and scope. So in general life or in auditing, to create a strategy, we need to know the direction, timing, and scope. To create an audit strategy, we need to consider the scope of the engagement. For example, which years the external auditor is going to review, or because normally we review the last year, but probably we need to review more than 1 year. So we need to know which years we are going to review, for example. This is related to scope. Reporting objectives. What will be the reports that the external auditor is going to deliver to the company? Could be only the opinion about financial statements, or could be another report, or could be a tax report, or it could be, I don't know, another kind of reports. So all that reporting objectives, we need, the external auditor needs to discuss with the company. And according to that, obviously, the external firm is going to charge the fees of the audit. Timing of the audit. Do you remember that I told you that normally the external audit is divided into preliminary and final audit? Why this happens? Because obviously for some companies, they need to have a financial report at the beginning of the next year. So for the external auditor, it's so complicated review a whole year in the first months. So I remember, for example, a company that I was auditing, and that company required the financial reports in February, I guess, in the beginning of February. So obviously it was impossible to review all the year in January. So for that reason, we divided the audit, external audit, in two. The preliminary was around September, October, and then we review the whole months.
Is that preliminary? Is it interim audit? Is it the same?
Yes, it's the same audit, but divided in two.
Interim audit, huh? Interim
exactly.
And okay.
Exactly. So preliminary, in the preliminary audit, we review, for example, June to September, and in the final audit, October to December. And we deliver the opinion in January because the company needed to have the opinion by February. So for that reason, we used to divide the audits. Obviously, it depends on the size of the firm. If it's a very small firm, we can eliminate the preliminary audit. But if it's a very, very big firm, imagine, I don't know, Apple or Tesla or that kind of very big companies, those kind of big companies, obviously we need to divide the audit because it's impossible to get an audit in 1 month. Significant factors, for example, a specific sector. Some sectors, talking about, for example, banking sector, is very regulated. So we need to, in the financial sector, banks, for example, they need to have financial statements and another reports, or for example, companies that are public companies that are participating in a stock exchange, they need to have additional reports and they need to follow specific rules. So we need to, in order to create a strategy, we need to know what are the rules of that of the company, if the company belongs to a specific sector. And the last thing is the nature, timing, and extent of resources available for the engagement. So obviously every company has its own personality. So we need to be very, very conscious if we are going to get the information fast, or if we are going to, if the external auditor is going to deal a little bit to get the information. So we need to keep in mind that how is the administration, if the administration of the employees of the company provides and what is the quality of the information that we are going to receive. Before creating the audit strategy, identification of the key engagement partner, manager, specialist, preliminary engagement activities like acceptance and continuance is the stage in which we letter independent that it doesn't have. Sorry.
Can you talk about the preliminary? We are breaking off.
Before create a strategy, we need to find the members. So who will be the, we talk about the letter of the contract that we need to have, a letter in which the auditor is expressing that he doesn't have any conflict of interest, like for example that he's not part of the owner, for example, or some kind of issues that could create a conflict of interest. And in case that the previous auditor was another firm, we need to talk about the company with that auditor. If the same firm has been the same auditor for all the life of the company, we can avoid that last step. But if the company had another auditor, talk with the previous auditor. So this is a plan. Oh, sorry. In case of the plan, the strategy. Why? Because in the plan, we can. It's more detailed. Is when we are giving a kind of a structure of. We have first the strategy, and the plan is a strategy, but in detail with a structure. So in the plan, activities, depending on the members of the team, is more flexible, because we can change the plan, but we cannot change the strategy, because in the strategy we are looking for to reach a goal, and in the plan is the process, is the way in which we are going to get that objective. So the plan is more flexible.
Yeah. Yeah.
And it could vary according to the size and complexity of the entity. So for example, this could be an example of an audit plan in which we are going to, in this slide, we see here that the activities that each member of the team has to do, the month, who, so it's very specific. So this is an example of a plan. So then, in order to establish strategy, we need to know a lot, like for example, in industry factors, or the in terms of the sector, competitive environment, who are the competitors of the firm, supplier and customer relationship, technological developments. So many factors that we need to understand about the company. These factors, we will be able to develop a correct strategy. And then we're going to talk about risk. So risk, we have different types of risk. The companies, every company has risk. When we are developing the strategy and we need to know the different types of risk, because the could be crystallized in a certain point. So one of these risks is the inherent risk, is the risk that every company has because of the nature of the company. So we cannot avoid inherent risk. Inherent risk is a risk that always every company is going to have. We can mitigate that risk, but every company is going to have that risk. For example, in the transport sector, the inherent risk is crashes or collisions. So we cannot, in the transport sector, we cannot avoid crashes. So, but we can mitigate that probably if the company hires drivers with the license. So we are not avoiding the risk, but we are mitigating through a person that knows how, and the driver has a license. So we are mitigating that risk that is inherent to the sector. Or for example, in financial services sector, normally we can see different and very complex instruments that probably are very difficult to understand and to calculate, but the company could hire a person that knows a lot of financial instruments that can explain to the customer. So the risk is there. That probably the risk is that the financial services in the financial sector, and for that reason, probably maybe the company is not interested to buy that instrument. But how we can avoid that? Hiring a person that can explain those financial instruments. Or for example, in technology sector, cyber attacks. We cannot avoid cyber attacks. Manipulate or control it, but how we can manage, how can mitigate technology cyber attacks? Probably with a very, very strong system, with policies, procedures, some I don't know, maybe a connection with another webs or another systems. So it could be another example of inherent risk. Or for example, you could think about the health sector or the service industry. For example, in restaurant, I think we need to be aware that food is fresh. So because if the company sells something that is in bad condition, even the company could kill a person. So this is the inherent risk, the risk because of the nature of the company. Other risk is that when the auditor could express an opinion that is not the correct opinion. Someone or even the auditor manipulate the information, and for that reason the audit opinion, maybe we can the auditor gave an opinion, a very good opinion, a qualified opinion, but the auditor didn't check properly, and the auditor discovered that there was something important that changed all the scenario. So, but this is an audit risk, and how we can avoid that risk? Obviously, to be sure that the auditor is covering all the knowledge and experience in order to execute an external audit. So, but this is a risk. Detection risk is when the auditor cannot detect something. So there is another risk, because at the end the auditor is a human. So, but the detection risk is when the auditor cannot detect a problem or an issue inside the company. Control risk is when the company doesn't have a control to mitigate a risk, or the control is not working properly. So we can have these two scenarios in the control risk. When the company doesn't have a control, or when the company has a control but the control is not working. Legal risk, obviously all the company has legal risk in order to, if the company probably is not doing the things correctly, and the regulator can punish it, or maybe another person can demand the company. So this is a legal risk, but because we cannot control that legal risk, but we can mitigate it with controls. Operational risk is when someone or something is it's very important that if that person or that thing is not inside the firm or inside the entity, the company cannot execute its operation. For example, employees are operational risk. What would happen if the company lost all the employees? It could be an operational risk, because if the company doesn't have employees, how the company is going to operate? So employees are operational risk. Or for example, a machine could be operational risk, because if that specific machine doesn't work, the company cannot operate normally. So this is operational risk. Now, we're going to see the difference between accounting and auditing. Accounting is defined as managing an individual's or company monetary records. Basically, accounting is like managing money and reporting financial things, of financial issues or financial performance. And in another hand, auditing is the revision of the accounting. So the auditing is review all that records and all that that reports.
Okay.
Okay. So finally, we have here the developments in auditing. So in some years ago, was not the objective of the audit. So it means that the auditor was not looking for a fraud. The auditor was looking for give an opinion about the figures of the company. The fraud was not the main objective. But nowadays, obviously, in some sectors, again, the financial sector tends to have a lot of frauds. So, for example, auditors that are auditing financial sector tends to think more about fraud. So this is a difference that probably in the past, we are not thinking about fraud, but now in the present, some sectors need to think about fraud. In the past, for example, the external auditors only review figures and financial reports. But nowadays, the internal control is an element very important, because if the external auditor found that the internal control is very strong, it means that the reports and the information review is going to be better. So if we have a very strong internal control, the level of revision that the external auditor is going to give is less. But if the external auditor finds that the internal auditors, the controls of the company is very weak, they need to review more, because the internal control is not working. I don't know if you can understand that part. If the internal control is very good, the auditor is not going to review a lot, because the internal auditor, the external auditor trusts in the internal control.
Yes.
But on the opposite, if the internal control is weak, obviously the external auditor is going to think, okay, so the internal control is not good, so I need to check more in detail, because the internal control is not working. It doesn't mean that the result is going to be bad. It means that the auditor needs to do more work.
Yeah. to sample more.
Exactly. Another difference, another development in auditing is that internal audit has moved more in terms of cybersecurity, because nowadays everything, even do the shopping list, buying in Amazon, and all the sectors have that apps and that technological platform, and we can do many operations through the computer. So the cybersecurity is very strong nowadays, and for that, internal audit and external audit taking consideration the cybersecurity and cyber attacks. So is something that we are noticing nowadays, that probably, I don't know, maybe 15 years ago, we never thought about cybersecurity, because the presence of of technology in the day-to-day was not as strong as today.
As today, yeah.
Another thing that we can find nowadays is that the internal audit or the external audit is more automated. Exactly, because now, for example, if we are going to review, I don't know, maybe a report about accounts receivables, the company, I'm very sure that every company comes with a system that is a system that can generate a report. So every report that the external or the internal auditor is reviewing comes from a system that is probably in some of the cases very automatic. So this is another development and another change that we can find in auditing. So we finish now, but do you have any questions?
No, I think I was following up well. I've get almost all what you were elaborating on. Yeah.
Okay. So, but I'm going to give that presentation to the school, and you can. I'm going to tell them that if they can share with you this presentation.
Okay.
This would be a very good guide. The presentation doesn't contain everything, but is a good guide, and you can go read and maybe look for more information. But it's a good material to keep in mind. So maybe you don't have a question now, but if you have any question in another day when you read the presentation, just let me know.
So thank you very much. Thank you very much. I really, it was very